Hello, Chris and I are here to share some of the highlights from our North American ISA publication. Themes around the morning and the dawn of the new cycle certainly ring true in our outlook for the US and Canada. The risks on the horizon may be getting a bit more attention now than a few weeks ago, with some changes to the policy picture, notably related to higher interest rates and the election of President Trump in the US election. But let's get into some of our more specific outlooks regarding the next several years. Growth has been surprisingly strong in the US, and we expect it to remain so. A year ago, many, including us, were thinking there might be a short and shallow recession at the outset of 2024, but that didn't materialize. The outlook moved to a soft landing, and now we're almost in a no landing type scenario.
Canada's growth has lagged the U.S. for the second straight year in 2024, but we avoided a recession that was predicted earlier in the year by economists. Elevated interest rates have had more of a negative impact on Canada's housing market and broader economy, but this is expected to dissipate as interest rates move lower and stress on the housing market eases.
Interest rates have been, and we expect to continue to be, the most important factor driving real estate's investment performance. There are two big challenges this creates. One is that interest rates are very hard to predict, which means that market sentiment does move around a bit as interest rates change. The second is that good economic news can lead to higher rates, which creates a good news is bad news type outcome.
Canada's 10-year bond is currently 115 basis points lower than the U.S. 10-year Treasury, where historically that delta is about 80 basis points lower. Inflation has retreated further in Canada than the U.S., currently sitting at 1.6%, which is within the Bank of Canada's target range, and as a result of lower inflation, the bank has cut its policy rate by 125 basis points thus far in 2024, with a further cut expected in December, and then even further cuts expected in the first half of 2025.
Since the end of September, the U.S. 10-year government bond rate has moved higher. But a mitigating factor to concern about the real estate value impact of this is that real corporate rates have been stable. This captures the tightening of the risk spread that comes with a better economic outlook and adjusts for inflation, which real estate can help hedge. Another element of the outlook that we want to highlight is the growth trajectory of the US and Canada. In recent years, job growth, along with population growth, has been a positive for the US and Canada relative to the rest of the G7. We expect this to continue, but there is some downshifting to keep in mind. In the US, the election of President Trump means more limited migration is likely, which will slow population growth somewhat.
And in Canada, immigration levels were increased after the pandemic to fill job vacancies, which drove record population growth in 2022 and 2023. But this put significant strain on Canada's housing market and social services. So the government will be temporarily lowering both permanent resident admissions and temporary foreign worker and student immigration levels in 25 and 26. This will undoubtedly impact the retail and apartment sectors in Canada and the student housing sector. And in recent years, those sectors had benefited immensely from strong population growth.
In keeping with the morning theme, the next idea in the ISA is that hangovers sometimes come in the morning. The real estate market has some of this hangover in the form of distress showing up in the US office and apartment markets. The first thing to note is that we don't think interest rates are going to fall fast enough to allow a pretend and extend strategy to actually solve these problems. This means that action on the part of lenders and owners is going to be needed. It's also worth noting that office distress is much worse than apartment distress. Many office buildings have seen values decline below the loan balance and have capital requirements that require resolution in the near term. For apartments, the pain is not as severe, and distress is only to the point that loans cannot be refinanced. This could create some structured investment opportunities, but the volume of these has been limited thus far. Canada has a more conservative lending environment and thus limited distress overall. Moving to real estate sectors, the first thing to note is that in recent years, sector selection has been a huge opportunity to generate outperformance. This tapered a bit in the last year, and we expect it to come down more. This doesn't mean that sector selection is unimportant, but it means that market, location, and asset selection will become more significant to generating outperformance. It's also worth noting that the sector views we share here are generalized, and often within sectors, there are investment opportunities that run counter to the high-level trends. The broad trend for US and Canadian property types is to see vacancy trending lower, or at least flat in the case of Canadian retail and apartments over the next 3 years. Some sectors are approaching a cyclical peak in vacancy after a period of very elevated new construction or after a period of demand challenges. Our views on US apartments are a bit more negative than what others in the market are seeing. There are some policy-related headwinds we're keeping in mind, but the other thing is that the slowdown in new supply is something that's still a year away in our minds, which means that there's the risk of rising vacancy rates in the next year.
While apartments in Canada historically have had much lower vacancy than the US, given the recent plans to reduce immigration levels in 2025 and 2026, we have raised our vacancy forecast. Vacancy is currently at a 40-year low, but we are forecasting an increase in vacancy in the coming years as new supply remains robust and obviously demand will slow.
We see industrial is very well positioned in both the US and Canada, as the rate of new completions is already down and vacancy remains below the long-term average. Pricing is also down more, which in our view improves the relative value to other sectors.
Retail in the US and Canada have similar vacancy rates, both currently and in our 3-year outlook. Both countries have benefited from low new supply levels and healthy demographics, but there is wide variability in the quality level of different retail property types, despite the good overall market fundamentals. The key point about retail here is that asset selection is critically important.
And finally, the much discussed and debated office market. The impact of remote working is running its course, and we have seen demand start to move positive in both the US and Canada. The path to healthy vacancy rates is going to be a long one, but investor sentiment might start to move with the introduction of positive demand. There are likely to be some interesting office investment opportunities in the coming year, but asset selection and careful underwriting will be critical to identifying value. We think value declines on the order of 50% are needed in the US office market to create those attractive investment opportunities. And in Canada, that can be a bit less because office leasing economics remain more favorable than in the US. The final morning theme is the early bird gets the worm, and we relate this to our outlook for capital markets. Chris is going to share some comments about the capital markets in Canada, and then I'll discuss the US outlook, including some interesting new data we use to inform our perspective on the trends.
Our assessment of capital market signals in Canada is that they are broadly better than they were 12 months ago in virtually all measures. CPI inflation has fallen below 2%. Short-term interest rates are falling sharply. Longer-term rates are starting to trend lower after peaking in mid-2024. Our yield curve is no longer inverted. Lending spreads are coming in. And cap rates have either flattened off or in some sectors started to decline. Investor sentiment is improving based on recent surveys, with dry powder ready to be deployed. And finally, transaction levels, as Rich mentioned, are expected to rise, albeit slowly, following the subdued levels of the last 2 years.
The idea that the early bird gets the worm is certainly supported by data from past cycles. Analysis of the MPI and Odyssey returns coming out of the GFC shows that the best years for investing were right after the GFC, both at appraised value as measured by Odyssey returns and at market value as measured by MPI assets acquired in each year. As discussed in the global chapter, we do not expect the same magnitude in this cycle, but directionally the same result. Bad vintage years often correspond with periods when capital is being pulled out of the real estate market. And this is supported by analysis of some aggregate data on US pension funds from the Public Pension Fund database. Here we see that allocations relative to targets for pension funds is generally driven by changes in stock and bond performance, which make up the majority of those pension fund portfolios. 2022 was a bad year for stocks and bonds, which contributed to pension funds moving from an underallocation to real estate to an overallocation to real estate. This led to fund redemptions and limited new capital for real estate. 2023 then was a good year for stocks and bonds, and 2024 is looking to be the same. This is helping bring down real estate allocations, and we think will enable new capital flows to real estate in 2025. Another challenge for real estate capital flows has been a limited amount of capital coming back from closed-end funds. Data from Cambridge Associates shows how distributed capital as a share of paid-in capital has been flat over all vintage years in the last couple of years. This lack of returning capital limits the amount of new capital commitments a plan needs to make to sustain its real estate allocation. There have also been challenges on the open-end fund side that we think are going to start to clear in 2025. For those looking to return or reallocate capital, many open-end funds have been faced with large redemption queues, which limited plan flexibility. And for those looking to place new capital, appraisal lag concerns meant that it was not yet time for new capital commitments. But in the last quarter, property appraisals have stabilized, which we think will be a green light to those looking to place new capital. But despite those vintage year and fund flow dynamics, we think transaction volume will recover slowly. In part, this is because a good vintage year for buying is often a poor vintage year for selling. So there are less investment opportunities available. We just want to close with a few of our key looking ahead points. As just mentioned, the capital flow dynamics are going to lead to real estate transaction volume seeing a slow recovery, not a rapid recovery. And with this, we think that real estate index returns will trend higher, but income will be the majority of that return, with appreciation contributing a limited positive return. On sector selection, we think that industrial will outperform apartments, both in terms of rent and value growth, due to the timing of the recovery being sooner. For office, we think investors will start to seek higher returns and consider buying again. Risks remain elevated and pricing could run past what we consider attractive, but we think the market will start to see more liquidity. And finally, we expect that climate change and residential rental affordability policies will be a growing factor in relative investment performance. This is going to show up at the local level, even as those issues are not necessarily national policy priorities. We thank you for your time. Keep a lookout for our ISA publications, including the ISA Outlook sections, and we hope you continue to watch and read.